going to show you an algorithm that not only beat the S&P 500, but it beat it by a wide margin, upwards of double in the course of a couple years. This algorithm is actually really straightforward, and once you understand it, you can implement it into your own trading or own investing as well. To start, I'm going to show you just the basics of what this code essentially does. It essentially looks at a stock and calculates the rate of return and then the risk of said stock. So right now, you can see beneath the terrible drawn lines that the rate of return is generally just going up, and then the risk has a certain range. And generally, big risk, more volatility, like let's say if it still goes up, but it goes up, down, that's bad. But a low volatility, a low risk, up, down, is good. Because if you want to actually mathematically predict something, it's going to be a lot harder to do it if it's volatile. And from that, we are looking to specifically maximize an equation called the Sharpe ratio, which is, if you could see it on the screen here, is the rate of return of a stock or portfolio divided by the risk minus the risk-free rate of return. And from that, create as effective of a portfolio as possible. And what better way to do that than by picking out all the stocks in the S&P 500 and putting it through this algorithm. So yeah, this is how to do it. Put in the start date right here, put in the end date after downloading the GitHub link and just installing it and clicking on the main.py, run it in VS Studio, and then just wait. And after done waiting, which is probably going to be like a minute or two, you're going to be given a few outputs here, being the clean data, the optimal portfolio results, the holding analysis, a graph comparison, and the rate of return and covariance. So to break down how this works more specifically, you can click the video down below, which will show you the mathematical step-by-steps. But the gist of it is essentially getting all of the data for all the stocks in the S&P 500 over a specific time range, cleaning it, calculating the rate of return for each stock, and then create the covariance matrix of all of this. The covariance matrix is basically how much a stock varies relative to another stock. So, for example, let's say you have stock 1 and stock 2. Stock 1 goes crazy, stock 2 goes completely normal. In this case, this means it has a low covariance. But when you look at, in this case, another pair of stocks, and one goes crazy and the other goes crazy, this is a higher covariance. And so essentially what this whole graph is assessing is the covariance between each and every single stock. And then from that, what would be the optimal weighting of the stocks to create a Sharpe ratio that would be as high as possible, meaning the lowest variance, in this case, this is covariance, so the variance, and the highest rate of return. And from that, this creates the portfolio, which we actually get to see right here. In this case, from 2014 to 2018, these were the top performers. These stocks, and the optimal weighting for this to maximize our Sharpe ratio is 13% in CZR, 5% in NVIDIA, 7% in Amazon. And from that, we are able to see how the portfolio performs compared to the S&P. And as you can see with the portfolio, it has actually outperformed the S&P 500, albeit in a bit more volatile of a manner, which is the Sharpe ratio predicted. We went to the portfolio holding analytics. We can actually see that the risk of this portfolio is higher than SPY, the S&P, because it's slightly more volatile. Albeit the return is significantly greater, which is why the Sharpe ratio is so much higher in this case. And overall, this graph actually shows that we've predicted this significantly in this case. It's performed double the rate of the S&P in the course of 5 years. But something I found that you'll actually see for yourself too is that if you look at right after a market crash and use a Sharpe ratio then, the rate of return significantly increases. For example, when you look at the S&P versus the portfolio percent change with right after the 2008 market crash, we are able to see which stocks were most resilient, exhibiting a neutral or better yet positive rate of return and a low risk. Invested in those, and from that, in the course of 5 years, we've already got, instead of a 300% rate of return, like our most recent one being in 2014 to 2018, we've exhibited a 500% rate of return. And overall, in the long run, up to present day, you'd be experiencing a 3,600% return. Meaning, if you put in $1,000,000 into this, in the course of 10 to 16 years, you would get upwards of 30 to 36 million. So yeah, test this out for yourself because this algorithm has a whole lot of implications in terms of investing and when to invest as well. So yeah, if you guys have any feedback for me or any other ideas on what coding I should create next, give me a comment down below and I'll go ahead and build that. If you guys like this video, just give it a like and I'll see you soon. Later.